Silver just posted its best single-day performance of 2026, and you might not even know how significant it was. On Friday, February 27th, silver opened the session at $88.06. By the time markets closed, it had surged to $93.82, a massive 6.3% single-day rally and the largest daily gain since the January blow-off top when silver was racing toward $121. Regardless of whether your holdings amount to 1 ounce or 1,000 ounces, your entire position appreciated 6.3% in purchasing power within a single trading session, while the S&P 500 delivered nothing noteworthy. To put it in concrete terms, if you hold 100 ounces of silver, your position gained roughly $560 on Friday alone. At 1,000 ounces, that figure climbs to $5,600, all accumulated in a single day while you were likely at work, not monitoring your phone, not studying charts. Your metal simply sat in your safe, completely inert and appreciated in value. But Friday's performance is already in the rearview mirror. It is Saturday. Markets are shut. And the real question on every silver stacker's mind this weekend is not what took place on Friday. It is what unfolds on Monday. Because the data emerging from Friday's session, and I mean precise, measurable, independently verifiable data, indicates that Monday morning could make Friday's move look like a mere prelude. Let me address the essentials right away so we can concentrate on the numbers. This is not financial advice. I'm not a licensed financial advisor. I do not manage capital. I do not sell courses, trading signals, mentorship programs, or any paid products. If anyone uses this channel's name to solicit money from you, it is a scam. Report it, block it, and move along. Every figure I reference has a named source. Verify every single one. Your holdings, your choices. I simply ensure you have the data that mainstream financial media conveniently overlooks. What your silver is actually worth. Right now. Not based on Friday's closing price, but based on what the physical market declares it is worth, because those are two fundamentally different numbers. COMEX says $93.80. That is the paper price, a figure generated by a futures exchange where contracts outnumber physical metal by a ratio of roughly 400%. Shanghai says approximately $108 to $110 equivalent. That is what Chinese buyers are actually paying for physical silver right now, this very weekend, on an exchange that mandates 100% physical delivery. No paper settlement, no cash alternatives. Deliver real metal or the transaction does not happen. The US Mint says $173. That is what the United States government charges for a single ounce of fabricated silver in the form of the 2026 American Eagle Proof coin, a 92% premium above spot. Your local coin dealer says approximately $110 to $114. That is spot price plus the 18% to 22% retail premium that dealers are currently imposing, alongside allocation limits and back orders because they simply cannot source enough metal to satisfy demand. So what is your silver truly worth? $93.80 on the paper market, $108 on the Shanghai Physical Exchange, $173 at the sovereign mint price, $110, $114 at retail replacement cost. Four prices, identical metal. The lowest price is produced by the market with the least physical metal and the most paper leverage. Draw your own conclusions. Why Monday is critical for your position. Every sentence that follows is a verifiable fact. Every fact carries a named source. Let us proceed. Friday's rally was not retail enthusiasm. It was a short squeeze. Here's the evidence. Open interest on COMEX silver futures declined to approximately 117,879, 125,000 contracts, down 2,000 to 8,000 contracts on a week-over-week basis. When price surges 6% while open interest simultaneously declines, that is the textbook definition of a short covering rally. Shorts are buying back their positions and closing them out. They are not exiting voluntarily out of indifference. They are exiting because holding those positions has become financially unsustainable. Lease rates at 8%, registered inventory at 86.1 million ounces and shrinking, delivery demand at 98% in February. The shorts assessed the data and concluded, I am done. Their exit was your 6% gain. But here's the critical detail. They are not finished covering. Commercial shorts still maintain approximately 40,000 contracts net short, 200 million ounces of remaining obligation. The covering that generated Friday's 6% move only reduced open interest by 2,000 to 8,000 contracts. That leaves 32,000 to 38,000 contracts of short exposure still outstanding. The squeeze has begun. It is not concluded. The short covering that delivered your stack a 6% appreciation on Friday potentially has 32,000 more contracts to unwind, and each contract that gets covered represents a buyer pushing prices higher for the remaining shorts. If covering 2,000 to 8,000 contracts generated a 6% gain, Covering the remaining 32,000 to 38,000 could produce returns that make Friday look like a rounding error. Not guaranteed. Market dynamics are nonlinear, but the fuel for continuation is right there in the COT data, publicly available at cftc.gov. Verify it yourself. First notice day, the number that makes Monday. Compelling Friday was first notice day for March 2026 silver futures, marking the entry into the delivery window. Here is the figure that makes Monday particularly interesting. 10,500 contracts are standing for delivery. At 5,000 ounces per contract, that equates to 52.6 million ounces of physical silver that contract holders are demanding. 52.6 million ounces demanded from a registered pool of 86.1 million. That represents 61% of the entire registered category consumed by a single month of deliveries on a single exchange. 61%. If your bank informed you that 61% of their deposits were being withdrawn in a single month, you would characterize it as a bank run. This is a vault run, and it is occurring at the very exchange that determines the global paper price for silver. Your stack is indifferent to vault runs. It resides in your safe. It requires no counterparty to fulfill a promise. It does not need an exchange to locate metal it may not possess. It does not need JP Morgan's authorization to exist. That is the fundamental purpose of physical ownership. You extracted yourself from the counterparty chain. Every ounce you hold is an ounce that does not depend on COMEX's delivery capability or Shanghai's willingness to sell. You already possess the metal that everyone else is scrambling to acquire. The gold to silver ratio, why this number matters. For relative value. On Friday, the ratio dropped to 56.3, gold at 5,278, silver at 93.80. To appreciate what 56.3 signifies, context is essential. The 10-year average ratio sits at approximately 77.1, meaning historically, you needed 77 ounces of silver to purchase 1 ounce of gold. Today, you need only 56. Silver has become expensive relative to gold. But here's the part that matters for physical holders. During prior bull market peaks, the ratio compressed to 45 in January 2026, 31 in 2011, and 15 in 1980. At 45.1 with current gold prices, silver would be worth $110. At 31.1, silver would be worth $170. At 15.1, silver would be worth $352. The ratio at 56 suggests silver retains substantial room to outperform gold based on historical precedent. And your position captures every dollar of that outperformance because you hold the very metal that is compressing the ratio. That figure warrants repetition, 187%. If you acquired silver a year ago at roughly $32 per ounce, your position has nearly tripled in value. If you purchased at the 2020 pandemic low near $12, your holdings have appreciated nearly eightfold. If you bought at the 2024 average of approximately $25, your position is up 275%. Identify another asset class that produced 187% year-over-year returns while you took zero action. No trading, no market timing, no management fees, no anxiety over earnings calls, CEO controversies, or accounting irregularities. You acquired metal, stored it in a safe, and it outperformed virtually everything on Wall Street by a margin that is frankly humbling for the conventional financial industry. Total COMEX silver inventories have declined to approximately 360 million ounces, down from 532 million in October 2025, a 32% decrease. Registered inventory, the deliverable category, stands at 86.1 million, down 24% to 30% in recent months. On Thursday alone, 1.221 million ounces were withdrawn. The daily withdrawal rate runs approximately 785,000 ounces per day, including Friday, including while this is being recorded. Vault operations do not halt for weekends. Metal earmarked for withdrawal on Friday is being physically relocated right now. Trucks, security convoys, loading docks. Your position gains relative scarcity value with every hour that metal departs the exchange system. The iShares Silver Trust recorded a single-day inflow of $3.44 billion earlier in February, the largest single-day share creation in the ETF's entire history. But here is what physical holders need to grasp. Those ETF inflows require authorized participants to source physical metal to back newly created shares. Every ounce flowing into SLV is an ounce not available as inventory for your local dealer, not entering COMEX registered stocks, not reaching a manufacturer. The ETF is competing with you for the same metal. And the ETF is currently winning because it is deploying billions in institutional capital against a finite supply. Declining yields diminish the opportunity cost of holding non-yielding assets like physical silver. When bonds pay 4.3%, Wall Street argues you should liquidate silver and purchase bonds for the income. When bonds pay 3.95% and are trending lower, that argument loses force. Capital rotates from bonds to metals. Your position benefits from every basis point decrease in yields because it renders silver comparatively more appealing to the institutional capital that drives large-scale price movements. The DXY at 97.65, softer on Friday, down 9% year over year. A weaker dollar means your silver commands greater international purchasing power. When the dollar depreciates, dollar-denominated silver rises because it takes more of a weakening currency to acquire the same ounce of metal. Your position is not merely appreciating in dollar terms, it is appreciating in real terms, because the dollars against which it is measured are worth less than they were 12 months ago. Silver up 187%, dollar down 9%. Your holdings are outpacing the very currency they are denominated in. That is the entire sound money thesis distilled into a single data point. Over the past 6 years, the world has consumed 820 million more ounces of silver than it has produced. Where did those additional ounces originate? Above-ground stockpiles, vault inventories, ETF holdings, recycled scrap? Those sources are finite. They are depleting. COMEX inventory is down 32%. Shanghai is down 91%. The buffer between production and consumption is being steadily consumed. Your holdings represent a portion of that buffer that has been permanently withdrawn from the supply chain. You're not going to sell it back to a solar panel manufacturer at $93 when the physical market indicates it is worth $110 or more. Every ounce in your safe is an ounce the deficit cannot access. This is the reality most holders do not fully internalize. Approximately 70% to 80% of global silver production originates as a byproduct of copper, lead, and zinc mining. When silver prices triple, you do not get triple the silver output. Production remains essentially flat because mine output is dictated by base metal economics, not silver economics. New mines require 7 to 15 years from discovery to production. No supply reinforcements are on the way. The deficit endures because the mechanism that typically corrects commodity shortages, higher prices stimulating greater production, is structurally impaired in silver. Your position benefits from a dysfunctional supply response that no price level can remedy. Silver closed Friday at $93.80 following a 6.3% V-bottom reversal. The RSI reached 75, technically overbought. But in a bull market, overbought RSI readings above 70 can persist for weeks during sustained trending moves. The MACD histogram is expanding positively. Silver penetrated the short-term downtrend line on substantial volume. 51,897 to 73,000 contracts traded Friday, well above the 30-day average. This is not a low-conviction move. This is institutional participation at urgent levels. Support has flipped. The $88.90 zone that served as resistance throughout the week has now become support. Former resistance converting to support is among the most dependable technical signals in any market. It indicates the buyers who breached that level are now defending it. Deeper support resides at $85, the 50-day moving average, and $78 to $80, the February correction low. Resistance ahead. $95 is the immediate hurdle, followed by $100. The $100 level is where the 2026 highs stalled in early February prior to the correction. A decisive break above $100 opens the path back toward the January all-time high of $121.64. The short covering remains incomplete. 32,000 to 38,000 commercial short contracts persist. Each one that gets closed adds buying pressure. Delivery standing at 52.6 million ounces against 86.1 million registered creates sustained physical pressure through March. Shanghai premiums draw metal eastward. Lease rates at 8% erode short positions daily. The dollar is weak. Yields are declining. The deficit is structural. The supply response is broken. Your position at 93.80 on a Saturday afternoon is not fully priced. The paper market reads 93.80. The physical market reads $100 or higher. The U.S. Mint reads $173. The lease rate signals scarcity. The delivery data signals crisis. The COT data signals a squeeze in progress. And on Monday morning, the paper market must begin reconciling with every one of those physical reality indicators. If you hold silver, you possess the only asset that simultaneously functions as a monetary safe haven, an industrial necessity, a strategic national security mineral, and a physical commodity in a confirmed 6-year structural deficit. Name another asset that satisfies all 4 criteria. You cannot, because none exists. Every source is named. CME Group warehouse reports for inventory and delivery data. CFTC commitment of traders for positioning. Shanghai Gold Exchange for physical pricing. U.S. Mint official product pricing. Silver Institute for deficit projections. Federal Reserve Fred database for yield and dollar data. London Precious Metals. Market for lease rates. BLS for PPI data. Every source is public. Every figure is verifiable. Am I too late? Someone posed this question in the comments last week. Here's the answer for anyone asking it now. Silver is up 187% year over year. And it is still trading at less than half its inflation-adjusted 1980 high. It is still trading below its January 2026 all-time high. It is still trading $15 below where Shanghai says it is currently worth. Registered inventory supporting the futures market has dropped 32% and continues falling. The supply deficit is in its 6th year with no corrective mechanism available. Too late for what, precisely? For the initial move, yes, that has already occurred. For the next move, the data indicates it has barely commenced. Your position does not require CNBC's validation to hold value. It does not need Goldman Sachs to issue a buy recommendation. It does not need the CME to refrain from halting trading at inconvenient moments. Your position is valuable because it is tangible, finite, industrially indispensable, monetarily significant, and situated in a market with a verified 820 million ounce cumulative deficit. That is not hype. That is mathematics. Share your average cost basis and how long you have been accumulating in the comments, not as a boast, but as documentation. Because this community's collective experience serves as evidence that patience, conviction, and physical possession outperform every algorithmic trading strategy, every leveraged futures position, and every paper derivative instrument in a structural bull market. You acquired metal. You held metal. You are prevailing. Saturday afternoon, markets closed, stack unchanged, value appreciating. Monday loading, data from public sources, names cited. Verify everything. Your silver is not merely a shiny metal in a safe. It is a position in the most asymmetric trade of the decade, and Friday was only the opening act.